So how do you determine what's going on in the housing market right now? For many of you, buying a piece of real estate will be one of the largest and most important purchases of your lives. And because of that, it can be a very stressful situation because you're going to want to make sure that your investment is going to be a wise investment, first of all, but also will carry you forward. I've been there myself and I totally understand. But we hear so many media headlines painting a picture of doom and gloom. And so you're left to wonder, well, what is truly happening? The fact is, no one really knows. But what we can do is look at historic data for predictions and also tap into credible industry forecasters. I'm always going to give it to you straight up, that I promise. And sometimes what I will say may not be exactly what you want to hear or were hoping to hear. But it wouldn't be right for me to mislead you if I felt otherwise. For example, there's been a lot of talk about a real estate market crash since 2020. For those that listened and waited for a crash to happen, those people have missed out on building equity, tremendous equity, and owning their dream home. Now, having said that, absolutely, the housing market is slowing down. There are less buyers in the market, inventory has gone up slightly, and for many of us, this is actually a welcoming change because the pace of demand just was not sustainable at the rate it had been going over the last 2 years. But the slowdown does not mean the prices will drop significantly, if at all, in most of the US markets. As a matter of fact, Fannie Mae, who has received plenty of awards in the past for providing the best market predictions, stipulates that prices will still move up this year, but at a slower rate, an estimated 10.8% and about 3.2% in 2023. So maybe now you're wondering, well, why are prices expected to go up if it's looking like we're moving into a recession and the mortgage rates are continuing to go up? That's a fair enough question. I think it's important that we understand what drives the mortgage rates. Inflation and mortgage rates essentially go hand in hand. Per Investopedia, inflation is defined as the decline of purchasing power of a given currency over time. So inflation essentially means that too much money is chasing too few goods. That is the easiest way to understand it. Too much money and not enough to buy. We've seen that play out in many different markets, right? Including used car sales and of course the housing market. In the housing market specifically, we've had too many buyers in the market and just not enough listings to satisfy the demand, causing multiple office situations and a dramatic price increase in a relatively short period of time. And that's the fundamental supply and demand imbalance. Now, in an attempt to control inflation, the US Federal Reserve's main tool is increasing the federal funds rate to make it more expensive to borrow money. And this in turn decreases demand in all sorts of areas as consumers will spend less when the cost to borrow goes up. And that is exactly what the Fed is wanting for consumers to do: save money and not spend it. The Federal Reserve increased the interest rates already a few times this year, and they're more planned for this year, by the way. When the federal fund rate goes up, it is more expensive for banks to borrow money from each other. And the higher costs are transferred over in the form of higher interest rates on mortgages, for example. So then the mortgage rate on a 30-year fix is now at 6.4% as of June 2022, which is almost double of what it was in the beginning of the year when in January it was about 3.22%. Look at this chart here, which plots the 30-year mortgage rate versus the inflation rate from 1972 to 2019. And just by looking at the trend lines, you could see that the two rates are essentially working in sync. Inflation goes up, mortgage rates go up. When inflation goes down, the mortgage rates typically go down. There's one exception, and that is in the 2008 recession, which was caused by the collapse of the mortgage market itself. The mortgage market today is much, much better, and homeowners in general are on solid financial footing. Now, as of May 2022, the annual inflation rate was at a staggering 8.6%, but is expected to drop in 2023 when consumer spending starts dropping, and when that happens, the mortgage rates will likely start dropping as well. Now, there's a lot of talk about a recession, and so you're left to wonder, are we really in a recession already? The often cited identification of recession is when 2 consecutive quarters of the gross domestic product, also known as the GDP, which is the measure of US output, is negative. But that is actually not the official call of a recession. The official call is when the National Bureau of Economic Research, also known as the NBER, calls a recession. However, many economists have already pointed at the very high likelihood of a recession towards the end of this year or beginning of next year. I absolutely believe we're headed down that path because when we look at GDP numbers for Q1, January through March, it was down by 1.6% and is also expected to decline in Q2, which is the April through June time period. The initial GDP estimate for Q2 should be coming out July 28th, but the Atlanta GDP tracker is already indicating that Q2 will come in negative. If we're headed into a recession, why is the unemployment rate so low? What is interesting is that right before a recession, the unemployment rate tends to be very, very low like it is right now, which is almost counterintuitive, at least to me. Just look at this chart here. The vertical gray lines indicate periods of a recession. And what you will notice is the low unemployment rate right before a recession, and then it spikes up. As of May of this year, the unemployment rate was just at 3.6%, which is considered very, very low. But because of the inflation and talk of a recession, plenty of companies now are starting to lay off, such as Meta, Netflix, Uber, Microsoft, PayPal, and plenty of mortgage companies even. They're all getting ready to cut costs, and they're starting their layoffs now. I foresee many more of these types of layoffs to be announced as the months go on, and I do expect the unemployment rate to increase into next year. Now you're probably thinking, well, you're hinting at a definite recession and an increase in the unemployment rate. This must result in decrease of real estate prices this year or next year, right? Well, let's look at this chart here, which illustrates the S&P Case-Shiller U.S. National House Price Index over a period of time. The grayed out areas indicate U.S. recessions. For the exception of the 2008 recession, which again was caused by the mortgage collapse, the housing market holds up pretty well during recession. And there are other charts that go out even further, and the housing market has consistently stayed strong during those other recessions as well. Looking at all these data points we have reviewed and hearing industry leaders forecast, I don't believe the prices will come down significantly or at all in the U.S. this year or next year. And the oncoming recession is actually forecasted to be a rather mild recession for one. While a recession can hit people hard, mortgage rates do typically drop, opening up new home ownership opportunities. New construction projects may be slow because of cost-cutting efforts, balancing out the supply and demand to a level where prices stay closely to the same. Now, what we also need to factor in is the current supply and demand imbalance. Housing supply is at a historical low, as you can see from this chart here, which is an official chart from the White House. This chart is actually a great example of how the real estate prices are driven by supply and demand. As supply goes up, prices go down. As supply goes down, prices go up, assuming demand stays relatively consistent. Here's also a curveball. We're expecting an increase of demand from a generational group called millennials, which were born from 1981 to 1996 and are between 26 and 41 years old today. Millennials make up the largest generation population in the world, and according to Freddie Mac's Millennials and Housing Research, the majority of them are still renters, but as they age and form households, they will become first-time home buyers. So the largest population generation will be buying homes in years to come, and that will place extra housing demand pressure. Now let's look at Sarasota Data just to provide you with an example of what's going on in this market. As you can tell, both the average and the median price is at an all-time high for June. Not what you expected, right? Because there's so much talk of a recession. The interest rates have come up quite a bit, but we're not seeing it reflected in the June numbers. This is significant because real estate in Florida typically slows down in the summer. Let's look at the sales price list ratio. It has come down from 103% in April to 100%, and this means that homes are in general selling at list price and not above that. The average days on the market was 19 days. That is the number of days the property is on the market before it sells, which is the lowest in over 3 years. But what we have seen is plenty of listings with price adjustments, so they're dropping the prices here in the Sarasota market. But I believe it's because sellers can no longer be aggressive with their pricing strategy. So what would happen in the past is that sellers would price their home way over a comp in many cases, and they can no longer do that. Buyers have a bit more say in the market now. Why do I believe that this is the case? Because when we look at the average sales price per square foot, it still has gone up in June. One of the reasons why we have experienced these very fast-moving price increases over 2 years is because of the bidding wars, which resulted in some offers coming in way above ask. And those offers, once they were accepted and actually turned into a closed deal, set the new standards for comps. However, overbidding is far less likely these days, keeping prices way more in check. So the housing market is slowing. There are less buyers buyers in the market, but there's still also a shortage of home supply. This slowdown is not expected to result in any lower prices overall in the US, though this is going to depend on the local real estate market, and I recommend that you speak to a local realtor and get their input. They can also pull data trends for you, and I recommend you ask them to do that, right? Because you want to see how the market has been trending over a period of time. But with the real estate market slowing down, I do believe you have more time to make a wise decision. You also have less competition, making the chances of you getting a home far easier these days. Now, should you buy now or wait? That is an absolute personal decision, and you're going to need to go with what feels right. But if you're selling high to be able to live in Florida, I think that's probably one of the easiest decisions. Then sell and buy now, but also take your time to find your dream home. Now, for first-time home buyers, should you rent now and wait until the interest rates drop again? Maybe have a professional run a financial analysis with different home prices and mortgage rate scenarios to help you make that decision. Now, I realize that this housing market has been unprecedented in the last 2 years, just like the last 2 years have in so many other ways. If you learned something new, if you enjoyed this video, please like this video. I would really appreciate it. If you're interested in the Sarasota market, I'm here to help you in your real estate journey and can be reached anytime for any questions and support. Thank you so much for sticking around and being here with me until the very end. I always appreciate it when you do. Take care.